Have you ever wondered how you can turn a recession into your financial advantage? Well, today's your lucky day, as we're about to unravel the investment strategies of thriving in the next recession. Now, let's dive into the heart of the matter recession. Imagine it as a roller coaster ride full of twists and turns. While it might seem daunting, understanding it is the key to unlocking investment opportunities. A recession is like a prolonged cloudy day in the financial world. During this time, businesses slow down, unemployment rises, and consumer spending tightens its belt. It's a challenging phase, and recessions are often triggered by various factors like a decrease in consumer spending, a decline in business investments, or external shocks such as the bursting of speculative bubbles. But here's the crucial point for all you investors out there. During recessions, asset prices often go on sale. It's like a massive clearance event for stocks, real estate, and other investments. On average, a typical recession in the United States results in a stock market decline of around 30%, and they tend to last anywhere from 6 to 18 months. So it's essential to be prepared for both the financial turbulence and the potential opportunities that come with it. This is where the wise investors see an opportunity. They know that in the world of finance, buying low and selling high is the name of the game. As the legendary Warren Buffett once said, "Be fearful when others are greedy, and be greedy when others are fearful." Now that we've decoded recessions, it's time to zoom out and explore the economic cycle. It's the canvas where recessions unfold, and grasping it is crucial for financial success. Understanding the economic cycle is like peeling back the layers of an onion to reveal the core of financial dynamics. Economies operate in cycles, much like the seasons of weather. These cycles consist of 4 phases: expansion, peak, contraction, and recovery. During the expansion phase, the economy is on fire. Businesses are thriving, jobs are plentiful, and the stock market soars. It's like the sunniest, most productive days of the year. When we reach the peak, it's like reaching the summit of a mountain. Things can't get much better. Prices are high, optimism reigns, and it feels like the party will never end. But just as night follows day, we move into the contraction phase. This is where the recession comes into play. It's like the weather turning gloomy and rain clouds gathering. The economy slows down, businesses retrench, and consumers become cautious. After the storm of a recession, there's the recover phase. It's like the first rays of sunshine breaking through the clouds. During this phase, the economy gradually starts to pick up steam. Businesses adapt and rebuild, jobs return, and consumer confidence begins to grow. Here's the fascinating part. Recessions are a natural part of this economic cycle. They serve as a reset button, clearing out excesses and allowing the economy to recalibrate. On average, these recessions occur every 8 to 10 years. To truly grasp the dynamics of recessions, we need to look at more recent history. Let's delve into the lessons learned during the 2008 financial crisis and the dot-com bubble burst of 2000, where some companies faced dramatic falls before bouncing back stronger than ever. Let's look at how tech giant Apple weathered the 2008 financial crisis. Before the crisis, Apple was already a tech powerhouse, with its stock trading at around $170 per share. However, during the crisis, Apple's stock price dipped to approximately $80 per share, marking a significant decrease of more than 50%. Nevertheless, Apple's resilience and innovation paid off. In the years following the crisis, its stock price soared, reaching over $700 per share by 2012, showcasing an extraordinary increase of more than 775%. Now, let's shift our focus to the dot-com crash of the early 2000s and how a tech giant, Amazon, demonstrated resilience and recovery. Before the dot-com crash, Amazon was a rising star in the tech world, with its stock trading at around $107 per share. However, during the dot-com crash, Amazon's stock price took a substantial hit, dropping to approximately $7 per share, a significant decrease of more than 90%. Yet Amazon's determination and long-term vision paid off. In the years following the crash, the company not only recovered but thrived. By the mid-2000s, its stock price had surged to new heights, reaching over $80 per share, marking an impressive increase of more than 1,000%. So, what can we learn as investors from the stories of Apple and Amazon? Firstly, resilience pays off. As investors, resilience in the face of market turbulence is invaluable. Just as Apple and Amazon rebounded from challenges, staying resilient during market downturns can lead to significant returns. Secondly, innovation wins. Don't shy away from innovation. Much like these companies harnessed change, investors can seek opportunities within evolving markets and technologies. Finally, long-term vision rewards. Maintaining a long-term perspective is key. Short-term market volatility can be weathered with patience and a focus on your broader investment goals. Now, armed with these lessons, let's dive into 7 key investment strategies for thriving in a recession. 1. Seek quality investments. Focus on quality over quantity. Look for companies with strong fundamentals, sound financials, and a history of weathering economic storms. These are the businesses that often come out stronger on the other side. 2. Invest in defensive sectors. These are industries like utilities, healthcare, and consumer staples that tend to be less affected by economic downturns. They provide stability to your portfolio during turbulent times. 3. Use a dollar-cost averaging approach. Instead of trying to time the market, invest a fixed amount at regular intervals. This strategy can help lower the average cost of your investments over time and reduce the impact of market volatility. 4. Keep cash reserves. Maintaining some liquidity in your portfolio allows you to take advantage of opportunities when prices are low. It's like having dry powder ready to deploy when the time is right. 5. Have a long-term perspective. Perhaps the most crucial strategy is maintaining a long-term perspective. Remember that recessions are a part of the economic cycle. Historically, markets have rebounded after downturns. Don't let short-term fear cloud your long-term vision. 6. Diversify your portfolio. In uncertain times, spreading your investments across different asset classes like stocks, bonds, and even alternative investments can help mitigate risk. Remember the age-old adage, don't put all your eggs in one basket. 7. Stay informed. Keep an eye on economic indicators and market trends. Knowledge is power, and being well-informed can help you make prudent investment decisions. These strategies can help you navigate uncertain times and potentially come out ahead. Remember, investing during a recession isn't about chasing quick gains. It's about building a resilient and profitable long-term portfolio. Now, I'd love to hear from you. What are your thoughts on investing during a recession? Drop your comments and questions below, and let's continue the conversation. If you found this video valuable, don't forget to subscribe. It helps support the channel and keeps you updated on our upcoming finance and investment insights. Thanks for watching.